Hannah Kessler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kessler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money. It starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money. We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKessler.com. Hannah spelled the same way forwards and backwards, Kessler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future.
Good morning, y'all. Hello. And as Mama TK always says, the choices you make today will affect your future. So how are y'all starting your mornings out today? Actually, I was thinking about this. I'm in the middle of creating a reel because, hear me out. Like some of the posts that have been kind of going like viral kind of a little bit ago, where people were waking up and having these like crazy morning routines. They'd wake up at like 3:30, 4 a.m. and they would go to the gym. They'd read the Bible. They would, dunk their face in a bucket of ice water and then rub banana peels on it. Have you seen those videos? You know what I'm talking about? So anyways, hear me out. I am not a 5 a.m. girly, okay? My preferred time to wake up is around like the 7:30, 8 o'clock hour. But it just works for me. So when I get up at that time, then I start my morning routine. Then I go to the gym. Then I do my yoga. Then I go take a shower. And then I start my day. And I really don't start taking phone calls until about the 10 o'clock hour, because that's just me. That's how I feel most fulfilled. And then I just work a little bit later, So I'm just kind of getting a little fed up with all these people posting like these, "Hey, in order to be a millionaire, you got to get up at 5 a.m. and this is the 5 a.m. millionaire morning routine." No. Design the life that is worth for you to live and what makes you happy. So anyways, I'm kind of like in the midst of creating this reel to kind of combat that, because hear me out. Not everybody is a morning person. People are night owls, okay? I stayed up way too late last night watching Kill Tony. Y'all know the comedian based out of Austin, Texas. Every week they bring on different comedians, kind of give them the spotlight. I love that show. So it's just me, and that's how I design my life. So how are you designing your life and the things that you want to accomplish for yourself, and what works for you? Because what works for you may not work for somebody else, and vice versa. So don't get so hung up in all of the social media pressure and saying, "Oh my gosh, I have to go do this because if I don't do this, I'm not going to hit this goal for myself." Just really design that life that you want to live. Anyways, just something that was on my mind this morning. Hey, another thing that I woke up to this morning, we have a family group chat, and I thought this was kind of funny. A family member of mine, I'm not going to call them out, all right, and pardon my French, okay? But they send us this post, and I'm going to show it to y'all right here. "You are 100% effing in control of your life. Stop being a bitch." And I was like, wait, that's kind of good. That's like really fits like the Gen Z millennial tone. Anyway, so just a little PSA for all of y'all here on this Thursday morning. So as a reminder, I'm here. I go live every Thursday morning, 9 a.m. Eastern time, Money Mornings with Hannah, where we wake up your wealth. Join me with your cup of coffee or your breakfast and whatever you enjoy in the morning. And I'll be here every single Thursday. Now, let's get into some of the comments here coming in. Good morning, Mr. Dexter. You're here every morning. Misty, good to see you. Annette, good morning. And Dexter saying, you're the CEO of your life. Do it. Yes, sir. Yes, sir. So, hey, I have a special guest coming on at the bottom of the hour. Last week, we got into the conversation of velocity banking, and I wanted to start to introduce that concept to y'all. And I know I had to cut it a little short because I had to go up to Detroit, do that TV segment, and come back. Oh my gosh. And then I got sick. I got super, super sick. So like Friday night, Saturday, all the way until like literally just yesterday, I was so under the weather. I feel so much better. My voice is coming back. I feel more like myself. So we're feeling good. We're feeling great. Hey, but that didn't hinder me. I still hit the gym, still did my stuff. So I am feeling a lot better. But last week, I know I had to cut that episode just a little bit short because of my travels. And I wanted to bring in the expert when it comes to the velocity banking concept, as now I'm coining that term. And he is the gentleman that actually works at the bank. He does the marketing side for first lien HELOCs, but his bank is the one that handles all the underwriting, issues out the HELOC loans and different things. But I'm going to introduce y'all to him. He is going to be joining us in Tampa, Florida. All right, so Money Game Live coming up, not too far away. I mean, literally almost 5 weeks out, a month out or so. Tampa, Florida, February 27 for my VIP people, and then February 28 and March 1st, Saturday, Sunday, classroom's going to be in session. We have Les Brown coming out, Isabel Garino, residential assisted living, Dawn Pendleton, tax strategies, Gwalter's going to be getting into equity and multifamily. How can I get into real estate with none of my own money? Larry Steinhaus. Actually, Larry Steinhaus and I were co-hosting the event together. A lot of you who are part of the Money Multiplier family, y'all know Jeremiah Dew, part of the Banking Bros. He's coming out and emceeing the event. If y'all were there in Denver, you know how entertaining Jeremiah is. He's just freaking a hoot. But come and join us, Money Game Live. So go check out the website, secure your tickets, because, I mean, hey, we're about to sell out. I mean, seriously, this is kind of like your last big PSA to go and snag your tickets before we just totally sell out of the event. Now, today, good morning, Mr. Shane, as well. Good to see you. Hey, Mike. Good to have you on, man. Now, I want to show some visuals of how velocity banking integrates into or with the infinite banking concept. Just kind of a recap. And let me go in here and share my screen. All right. Y'all remember the calculator from last week where I was going through and I was showing you how this would make sense and when it would make sense for that specific individual. Now, here, let's just do a quick recap, I guess. When I'm going in here and I'm taking out this first lien HELOC, this is the amount of money that I'm borrowing from that home equity line of credit. I'm being charged the 8.5%. Yes, I know real life it's not actually 8.5%. Actually, you know who's giving me a call this morning? Mr. Chris Noggle. Mr. Chris Noggle, we are live today. You should be joining us on our live. Anywho's, we'll talk to him later. But for the HELOC, let's say that I'm going in here and I need to take out a loan of this $305,000. I'm going to be charged the 8.5% interest. As I was saying, 8.5% is not the real interest rate. I always just like to under promise, over deliver in real life. So I'm just going to tell y'all it's 8.5%. And how we're structuring this, it's just a vehicle, right? This first lien HELOC is just a vehicle for me to flow my money through, have access to cash or that equity, and then be able to use it for different purposes, whether it's investments or paying off my debts or doing home remodels. I'm just using that money.
Now, as I mentioned last week, the only time that this will make sense is if you have a large enough gap between your income to what's going out the door as expenses. So here I use the example of, okay, let's say me and my spouse, we're bringing in $15,000 a month together and our expenses are $10,000. So after expenses, I'm netting $5,000. And then I have to account for, I'm going to have those homeowners insurance and then the property taxes due every year, because that's not going to be included into this HELOC loan. You're going to be responsible to keep paying that each year out of pocket. And if I go in here to the calculations, it makes sense when this years to pay off is under 13 years. And the reason why is because of the interest that's paid. If you're not following me, go to last week's episode. You can find last week on the YouTube channels, Money Multiplier, or my personal channel, Hannah Kessler, and go watch that replay. But here it makes sense because I'm underneath that 13 years and now I'm not spending a whole lot of money and all of that interest that's paid to go and pay off this house. And why they call it the velocity banking, it really ties into the velocity of our money, because what's happening is all of my income is going into that first lien HELOC. I'm funneling all of my income through it, and then out of the HELOC, I'm paying my expenses. And when I keep chunking down more and more every single month, that velocity of that money is paying down this principal of this house, that I'm able to pay off this house in 7-10 years compared to the traditional 30-year mortgage here. And when Anthony comes on, and I actually see him back there in the backstage. Good morning, man. I'll bring you on here in a second. This allows us, and I'll have Anthony go in here and kind of break down like the payment schedule, right? Because even down below, it gets into how much am I paying down on the principal balance, how much is going towards that interest, and how much I'm paying it down each and every month. Now, before I bring Anthony in, I told y'all I wanted to start talking about how to integrate this with the infinite banking concept. So I'm going to remove here from the screen and let me do a new share for y'all. Stop screen. Let's pull this one up. I'm going to pull up my illustration, my policy illustration here, because I want to give y'all some visuals. So let's say that I have a scenario, and I had another real life scenario, but I didn't get permission from her to share her exact numbers. And I just don't, I like to ask for permission. So what I'm going to do is I'm going to use the handout. Okay. So in our presentation, themoneymultiplier.com, right here, there's a link, themoneymultiplier.com/presentation. If you go to that page, you can get this downloadable handout. This is the handout when I go around the country and I teach on infinite banking. This is the handout that I give to y'all. So these are the numbers that I'm going to be pulling from. But let's say that I have a lot of debt, and this debt I owe to credit cards, I owe to a private loan, I have a car loan, I have a boat loan, I have a condo, and I have a house. And if I add all of these debts up, I have a little under $470,000 of debt. Now, if you've seen our presentation, you know how we use the policy to pay off that debt. Instead of it taking 18 years to pay it off, we paid it off in 5 years and 1 month. But how could I go even quicker with this? If I could access some capital within inside of my equity in my house, could I go even faster with this? Now, again, this takes discipline. This is not for everybody, because you got to be disciplined with your cash flow. But if I marry the two concepts together, how would this work for me? So let's take this for an example. On all of my debts, let me shoot over here. So here's actually the downloadable handout so you can see all of this. On all of my debts, right here from the left-hand side, these are all my credit cards, the Discover, Chase, Amex, Barclays, Lowe's, Nordstrom's, Wells Fargo. There's your private loan, the car loan, boat loan, the condo and a house. And when you add all this up, it's a little under $470,000. If I can tap into the equity in my house, and let's say that I can take out $300,000 from that house, what I'm going to do now is take that $300,000 and I'm going to dump that in to my whole life policy. Whole life policy designed for high immediate cash value. I could take this 300 grand and immediately within 30 days, I would have access, I'm going to call it $260,000 of cash. And I'm just going to look underneath here on the guaranteed side of this policy. I could take this $260,000 of cash, and then what I could do is I can start paying off these debts that I have. Well, Hannah, why would I do that? Why would I dump the money into the policy first? Well, hey, if you're new here, the whole reason why we funnel money through the policy first is because once the dollars hit the policy, now starts the uninterrupted compounding that's going to be happening in that policy for the rest of my life. Because I'm taking out a policy loan. I'm not just withdrawing the money out. When I take out that policy loan, what that means is I put my policy up for collateral, my death benefit, and I'm borrowing from the general funds of the insurance company. I'm using their $260,000 in the real world, and that's how and why my $260 still remains in the policy to grow and compound as if it wasn't touched, aka what's called the opportunity cost of our money, if you want to go nerd out on it. So if I take that HELOC money, I dump it into my policy, and then I have access to $260,000, I could take that $260,000 and I can pay off all of these debts up to my house. I can pay off Discover, Chase, Amex, the credit cards, the private loan, BMW, West Marine, and the condo. Because I did the little math last night. Okay, here's my little sticky note. All right, you can do the math for yourself as well. But when I added up all of those outstanding balances from Discover to the condo, $253,000 is what I owe to those third-party creditors. I could take that money from the policy, go and pay all of them off directly. And then once I pay all of them off, now what I do is I free up this, where'd it go? Right here. This $5,484 a month. Okay, Hannah, hold on. How'd you get that $5,484? Well, how I got that is I took all of my monthly payments, my $160 to Discover, $200 to Chase, and I went all the way down. And that's how much monthly that was going out the door. Where'd it go? $5,484. So now once I paid off Discover all the way to the condo, I've just freed up $5,484 a month for myself that I no longer have to send to the creditors because they're happy, they're done with me. And now I free up that cash flow. So what I could do now is I could take some of that money, let's say $3,000 of it, I could take that money, pay that back to my policy loan, and I could take an extra $2,000, what's left over of this $5,484, and I could add that as more principal to pay down my HELOC loan. And so literally just within that first year, that first swipe, I just cleared off 11 debts here, 10 of the 11 debts that I have. You see what I'm kind of saying? I just want to give y'all some visuals. So it's just allowing me to utilize this velocity of this money, tapping into this equity within my house to be able to free up, get the control back to my hands rather than having to send out those payments every single month to those creditors. You see what I'm saying? Now, and then as we all have left now is just our house. And that's where kind of Anthony, I want to bring him in and start to have this conversation. Now, this is just one example, right? I just wanted to show y'all, hey, how can I use this with debts? Let me show you something else before I bring Anthony on. Look at this screenshot that I have. Let me pull it up here. I actually took this picture at one of our mastermind events. I want to say this was our mastermind in at the shores in Daytona Beach. I want to say this was like in 2019 or something is when we went through this example. Joseph was with us. He goes by Mr. Helock, so Joseph Kovacevic on the team. But just so that you can see kind of how the flow of money operates. Now, given this is an example of how I use it for investments into real estate, but let me point this out to you. Here is my HELOC. Okay, so normally with the infinite banking concept, the foundation is your policies. But when I integrate the velocity banking of it, I go a step down. Now my foundation is the HELOC, where all of my income goes to HELOC. Then from HELOC, it funds my policy premium. Then from my policy premium, I move that cash value out to my bank account, and then I'm paying off the debts. So we just walked through that debt example. Now, here's just the example of how the money flows, of if I use it for my real estate investments. We won't go so deep into that today. We can have a one-on conversation, or we're going to be getting into this in Tampa, like I mentioned as well. But instead of this being the real estate investments, just scratch this off and just put credit cards, boat loan, car loan, condo. And you're doing the same thing. It's just going into those different debts rather than being deployed out into investments, into more working capital for you. And then you'll notice everything comes back in and it goes right back to my HELOC payment. So just to kind of get you a visual to see how the money is flowing, because that's all it is just how is this money flowing for me? Okay, Mr. Anthony, I want to bring you in. Good morning, my friend. How are you doing?
Good morning. I'm great. How are you, Hannah?
Good. I know it's early for you, so thanks for joining us.
All right. That's all right. Early is it's relative, so it's all good. I'm excited to be here. Thank you.
So I know I'm kind of bringing you into the middle of this conversation. Real quick, for my people who don't know you, they know a little bit about you, but who are you, Anthony? What do you do? And what do you like to do in your pastime? Give us a little something fun about you.
Sure. So I'm a mortgage banker. I specialize in helping people improve their lives using a first lien HELOC. And you specialize in that. That's all we do here. And so I guess when it's the only thing you do, you learn a lot about it. So know a lot about how it works and who it works for. My background is actually not in finance. I started off, I left college and played in a band for a while. And so for fun, I'm a fiddle player. Went back to college, finished, joined a 3-person group. We ended up with 40 units that we owned and managed for a while. So that got me into real estate investment a little bit. Then I became a teacher. So I joined this program called Teach for America, which focuses on low income, high needs children. And that was a very big and important, satisfying part of my life, because I knew that my work was helping people. So I did that for 7 years, got my master's in education leadership. I was going to go the principal route, and then had kids with my wonderful wife, and my views in terms of what I wanted for the family changed a little bit. So went into the mortgage business. And the mortgage business is great, right? You can help people, and you got a great transaction, right? And you provide a great transaction for them. But the thing I struggled with, and the thing I struggled with in the band as well, is that I couldn't see how my work was really helping people. I couldn't see how my work was moving the needle or improving people's lives. Yeah, I get you a great mortgage transaction, but no one's going back to their mortgage guy and saying, thank you so much for the wonderful transaction that you did with my mortgage, right? It's like, do you have low rates? And then if there aren't problems, that's how it's supposed to be. But then I found out about this first lien HELOC product, and I learned that no one really knows about it. And I learned what it can do for people. People can use it to pay off their homes really, really fast and get completely out of debt, which for people that want to achieve that, this can help them accomplish that in a way that an amortized mortgage can't. It can help them save tons and tons and tons of money in overall interest costs. And it can also maintain liquidity with the money that they use to pay down their home, which means they can use that to invest if they want. And so when I learned about this, I was like, wait a minute, like I can help people and I can use my skill set, I think, of teaching people about things. And I'm in the mortgage space. So I dove all in. And so that's how I got here. And that's what drives me every day is knowing that if I do the work the right way, right? If we teach people and people understand this well enough to where they control it and they know whether it's a good fit for them or not, and they choose it when it is, then I still get to help improve people's lives every single day. And so that's what drives me. So that's a little bit about me. A little bit of history about the product, just real quick, about the first lien HELOC. Mm-hmm. It's not unknown. I mean, it's unknown here pretty much, but this is the main type of mortgage product that people in Australia use. So it's not like we just made this thing up, right? It's a thing, and it's used across the world. And so in the 1980s, this guy from Great Britain, not from Australia, but from Great Britain, actually brought the concept here, and that's where the knowledge about this started. This particular, at least for the masses, we'll call it. This product has been around since before the amortized mortgage was even created in 1913. So it's even been here in the United States for longer than the loan product that we know and that we think is the only one that's around. The challenge with it is like a lot of financial strategies, it stayed within a certain subset of people in the United States.
Yeah.
You're ultra wealthy. Your real estate investment strategies, those are now available to everyone. That was held by a certain group of people. I'm not going to say that they were hiding it from everyone else, but not everyone thought like an investor back in the day. And so it stayed within that. Morgan Stanley, US Bank, Wells Fargo, their wealth management departments have this product and have had it for a very long time, but they only offer it to their wealth management clients. Well, we want to bring this to regular people, right? There are certain qualities or certain habits that people need to have to succeed with this. That's true. But I don't think it deserves to be with those people. Everyone deserves to know about this. Everyone should know about this. And that's kind of what we're here to do. It's what I do, is focus on advocating and educating people on what this is, how it works, who it works for, so that you know what it is, because you deserve to know what it is, but also so that you can make the decision to move into it or once you've learned about it, if it's the best fit for you. So anyway, that's a roundabout, intro for me and who I am and kind of what we do. So.
No, good, man. Good. So talk to me. What are the biggest maybe struggles that people have wrapping their head around this? Because we got into, hey, you got to be disciplined with it. I always use the analogy of credit cards. Hey, are credit cards a great asset? Yeah, but should everybody have them? No, because they're not disciplined with their credit cards, right? So it's the same concept here, and even the infinite banking concept, because the only person who can screw this stuff up is you and how you use your policy.
Mm-hmm.
So.
Yep.
My question is, what are some of the biggest objections that you see people say about this, or the struggles that they have getting into it? What are kind of maybe like those FAQs people might be thinking about?
So the challenge, the first challenge is that it's not very well known. And you have these people on the internet, talking heads like me, who are like, hey, I've got this home loan you've never heard of. And guess what? You can pay off your home in 5 to 7 years. You don't even have to change your budget, and you can save a lot of money even with a higher rate. With what most people know about mortgages, that's impossible. It's too good to be true, right? And so that's the main struggle, is that what people do is they take what they know and they apply that understanding and those relationships and those assumptions here. Well, this loan product follows a completely different set of rules than the amortized mortgage does. So the main challenge I have is that when people apply what they know, which is right for amortized mortgages, when they apply that here, those assumptions here, it is impossible, period, right? Well, the reality is what we have to do is understand that this is a completely different type of home loan, and we treat it differently than an amortized mortgage. Because it follows different rules, we can treat it differently and to get different outcomes. So what I hope to do is name that fact, because once we name that and understand that this is different, then it's like, oh, how does this work?
Mm-hmm.
Right? Instead of it work, like everything I know gets applied here. It's like, well, how does this one work? Well, this works with money goes in and out freely. With an amortized mortgage, it's closed-ended. When you put the money in, it's locked away. That's a huge difference. That means you can treat this differently. Another one is the interest is calculated daily. Every single day essentially gets its own interest calculation based on that day's balance. That's different than a mortgage. So once we understand that, we need to work within that rule set. So that's a lot of it. Another challenge comes to, why would I choose a higher rate product over a low? I've got a 3.5% mortgage right now. Why would I ever switch that out, right? Well, that's assuming that everything's the same. You're right. If everything's the same, you would never do that. That'd be crazy. Well, everything's not the same. This is completely different.
Well, and that's why too, like in the calculator, you say, okay, because I want people to get this right here. This is what it finally clicks for them. This 30-year equivalent rate, the HELOC compared to the traditional 30-year mortgage, it's like you locking in a 2.15% 30-year mortgage rate, right?
Yep. And all that comes down to the amount of time that you pay interest. I like to use really extreme examples. So one of those is, let's just pretend that you could pay off your home in 1 year. And I asked, would you be scared of a 12% rate? And everyone's like, no. And I asked, well, why? And they say, because the time's so short. And I'm like, exactly, right? The time is short, which means if the time is really, and that's an extreme example where the time's really short, so it's easy to kind of make that connection. But if the time is shorter, the rate doesn't matter as much. That concept applies to 1, 3, 5, 7, 10 years. It's just the concept becomes less strong the longer the time frame. And so that's one reason how it's possible that it would make sense to switch out a high rate loan for a low rate loan, because if that loan could be paid off really, really fast, it could end up being a lot cheaper.
Yeah.
Right. And so that's different. It's different than an amortized mortgage, because we don't talk about the amount of time that we're paying. We talk about the rate. Because everyone's got a 30. I've got a 30 year, and if I have a 15 year, I know it's better. But I understand the concept, but we don't actually look at the numbers. But if we're comparing to a 30-year mortgage, if I have something else that I can pay off a lot faster, then the rate doesn't matter as much. And so what we do is we don't look at the rate on paper. I'm not coming to the table and saying, hey, I'm going to make you feel good, and you can go next door and brag to your neighbor and say you got a low rate on paper. That's not what we're here to do. What we're here to do is save people money.
Yeah.
Right. And so that's really what we do. And that's how the calculator can be used to kind of figure out what would the overall cost look like for you if you were to implement this.
Yeah. And what's so interesting, because honestly, Anthony, why I personally vibe with this so well is because when you and I are teaching our strategies, because really they're pretty much similar. I can say that they're similar, and it's rethinking your thinking. I just hear Nelson Nash talking to me right now. It's just rethinking your thinking, and it's not the rate that's killing us. It's the volume of the interest that we're sending out the door to other people.
Yep.
That's what I want to slice in half, and I want to recapture that interest that I would have paid to somebody else. How can I recoup that so I'm keeping it within my family?
Yep.
So I want to ask you this too, because this was a question that I asked, because I, being second generation into the infinite banking concept, I've never had to go down to the conventional bank to ask to borrow money. I go and borrow from the bank of mom and dad. And the bank of mom and dad, I mean, the lowest interest rate I have with them right now is my 10% van loan, because dad felt bad because my van flooded. And he's like, okay, I feel bad. So we won't do the traditional 14% like we normally do. We'll do 10% for you. But even I could utilize this to tap into that money to allow me to have access to the capital. Because me, for myself, mom has just done such a great job ingraining it into us kids that your dollar is your little green man. And I want to go put my green men to work for me, create an army of green men that are out there working. And then I can take back my time freedom, my location freedom for myself. Yep. And my biggest question to you is, I said, well, hey, thinking like a banker, when it comes to the infinite banking concept, it all comes down to who controls that loan. And that's why I like my policies, because I'm in control of that loan. If I can't pay it back 1 month, it's okay, because Hannah's in debt to herself. And I'm not going to come and call myself over the phone and say, hey, Hannah, where's your payment? I'm going to come and foreclose on you if you don't pay me your monthly payment this month. Right? And so my biggest question was, well, hey, is it possible? Could that bank retract that loan that they've given me? And I want you to explain that answer that you've given me when I asked you a few months back, because I was like, okay, I get it now.
So retracting, closing the loan, freezing the line, that is a common question that we get. And a lot of times the reason why that question comes to the table is because of what happened in 2008, 9, 10. Yeah. People had second lien HELOCs that when the crash happened, banks froze their lines, they closed their lines, and people got hurt big time because of that. And so there's a natural worry about that is valid. It happened with second lien HELOCs, not firsts. And so the fact that this is in the first lien position, so just so everybody knows, first lien position, all it means is that's the first entity to get paid if someone defaults. And so it's a safer position for banks to be in than a second lien position, because if you have simple terms, if you have a $100,000 house and an 80% first lien loan on it, that means it's an $80,000 loan that gets paid off first if the home defaults. If you have another $10,000 second lien loan, HELOC or HELOC on top of it, they get paid off after the first guy gets his $80,000, which means if the house only sells for $80,000 on a short sale, the second guy doesn't get any money. That's a very exposed position to be in. There's a lot of risk that comes with that. When you're in the first lien position, it comes with a much less risk because you get paid off first. And so, so there's a difference between the level of risk between the two. And so because of that difference, I think that's probably why first lien HELOCs really weren't affected by that. And so two main reasons. One is if you think about the crash, you had a lot of people that had first lien mortgages up to 80%, and then they had second lien HELOCs up to 100%, 105%. Well, what happened is you had a decrease in home prices by 20%, 30%. Well, guess what? When that happens and they sell the house, the first guy would get paid off, and then the second guy wouldn't get paid off at all. Well, they realized that. And so that means that they would have received no money. So it nullifies the loan because there's no equity securing that loan anymore. That to me is a huge reason why I think that they didn't decide to. Well, that's the reason why they closed the seconds and not the firsts. I know I said two, and I have this ready, but I'm drawing a blank, Hannah. But there's a second reason that's also really good.
It'll come back.
But when I remember, I will come back and I will explain it. And if I don't, I will send you an email. And Hannah, you can email everyone that too. I'll make a video of it. I'm sorry, I don't have any notes, guys. I didn't write down the notes.
No, and that's why we vibe so well, because dude, I just speak from the heart. I have no notes. This is my note for today. It's my sticky notes I did a little bit of scribbling on.
Yeah. Well, the reason why I'm a little embarrassed is I have said these things for 6 years now, probably 4 times a day, and now I get on Hannah's thing. Anyway, so all in all, the fact that it's in the first lien position gives the bank a much lower level of risk than with a second lien position HELOC. And so, so I don't think it's likely. It's important that the language is there, right? The language says, hey, look, we can close the line. It does give specific reasons, right? The main reasons are if you default, right? Or if you like ruin the property so much that it's not worth anything anymore. And so those are reasons that are there that give the bank the ability to do that. But there's language that does. So, you know, it's important to know, like, is it there? Yes. I'm not, you know, there's no reason for us to hide the fact that the language is there. But in terms of the reason why people are worried about it, it comes from the fact that HELOCs and first lien HELOCs get looped into this thought process, right? HELOCs got frozen during the crash, right? And they got closed during the crash. Now, it wasn't first lien HELOCs, it was second, but by default, first lien HELOCs get looped into that you know, that thought progression. So what I like to do is just kind of make sure that we separate the two, just like we do with mortgages. Hey, it's not a mortgage. We can't assume the same things because it's different than that, right?
Yeah.
And so, so anyway, that's a great point to bring up. Yeah.
And I did bring it up to the community too, that this actually replaces that mortgage. Okay. So it's replacing the mortgage that you have to just have that first lien HELOC open. Yep. And when we were talking too, this involves, then we got to go through some closing costs. This is a whole new a vehicle that we're opening up that replaces this mortgage. And a question I get a lot just myself, being known enough to make me dangerous, but I always send it to you to, hey, you're the expert in this field. What would disqualify people from this? I mean, can they use it on investment properties? Is credit score important? You know, what disqualifies people from actually having access to this? Now, I will say before you answer, we did get very deep into, you got to have a large enough spread between income and expenses for this to actually make sense for you because of that interest I'm paying to the bank. I want to make sure that I'm not paying so much money to the bank in that interest. But what would disqualify people?
So there are two conversations that we have with people. One, and the first one, the most important one, is should you get this, right? And it's in my job, our job. I manage the sales team here, right? I was the first originator here at the branch, and you know, trial by fire, you learn and you make mistakes, and the only reason why I know things is because I've made more mistakes than everyone, and it was painful at the time, but you learn from your mistakes. So, you know, I'm still making them, but not as many, and so you know, you learn about how to do this. So I manage the sales team. We've got loan officers here, but the first job that we have to determine is are we going to support someone moving forward with this if they wanted to, right? Our main job is to filter people out, right? Is to figure out, hey, look, is this going to be dangerous for you? That's number one, right? And if it's not dangerous, then it's like, okay, can you qualify, right? So should you get it, and then can you get it? And so our job is not to make it work for you. Our job is to find people that work for this, and if they don't, we tell them, right? So first is with the surplus, with the cash flow that the household brings in. If we think about the strategy, right? If we just make it as simple as possible, you deposit your money in this place, and that's a subtraction problem because that pays the balance down, right? You pay your bills, which means you take out from the HELOC, and that's an addition problem. And then you pay your interest, and that's an addition problem. That's the end of the month. It is a subtraction problem and two addition problems. It is no more difficult than that. I mean, there's more going on, but like in terms of what's happening here, you deposit your money in, subtraction, you pay your bills, addition, you pay the interest, addition, done, right? So if you go down by a bunch with your income and you go up by a bunch with your expenses and interest, down by a bunch, up by a bunch, down by a bunch, up by a bunch, you stay in the same place.
Yeah.
If you go down by a bunch, up by a little, right? Meaning more income, little expenses, interest, like down by a lot, up by a little. Well, now I'm below the screen, right? So that I'm showing you how low it gets really fast, right? But that's the concept. So you have to have more than you spend consistently every month. And it doesn't have to happen every month. I talked with someone the other day. He was like, 1 month I'll bring in $20,000 and then I'll have 2 months where I make 3, right? Well, that's 26,000 over those 3 months. If all he spent was $10,000 over that time period, down by 23, up by 10, he's paid his house down by $13,000, right? Yeah. So it's a net of the total amount. We explain it month to month because most people who are W-2 are month to month, and that's how most families function. But it doesn't have to be that way. So the question of should you get it, we run the calculator, we make sure that the cash flow is there. Then the question is, can you get it, right? So now if we're thinking about things that are going to be hard stops, disqualifiers, right? Credit score, right? I can go to 89.9% loan to value. So the home is worth 300,000. I can go to 269 something, right? You have to have a 720 score to be able to go there, right? To be able to go to 85% loan to value, we need to have a 700. And to be able to go to 80% loan to value, we need a 680 score. So 680 score for 80% loan to value. 680 is the minimum credit score that we can accept. Anything lower than that, we'll just have to work on credit to get it back up. Yeah. We need to show 5% reserves. So if it is a $100,000 house, we need to have $5,000 somewhere. You don't have to bring that to the table. You don't have to, you take it out. You just have to show that you've got it.
And Anthony, 5,000, I could show as liquid money sitting inside my policies.
You could sit inside. Exactly. So the cash value, well, the available cash value, if you've already borrowed all of it, it's not going to work, right? But the available cash value we can use as reserves, right? So checking, savings, liquid investments, not like crypto, you have to liquidate crypto, but liquid broker investments, that kind of stuff. 401k IRAs, you have to be able to borrow from the 401k. Some 401ks don't allow you to do that, but vested, and cash value of life insurance. And so we have to show that. Let's see. I can do all states, but right now I can't do Texas. They have funny HELOC laws. I can't do Alaska or Hawaii. They're sort of the stepchildren states that are funny. And then Maryland has to you have to have a brick and mortar inside of their state to be able to do mortgages. So those are the 4 states I cannot do right now, which is Texas, Hawaii, Alaska, Maryland. I can't do manufactured, mobile, or modular homes. If the home's on over 20 acres, I'm not able to do that either. That gets into residential versus ag kind of definitions, and so that's why. If you had, a derogatory event like a bankruptcy, foreclosure, short sale, we need to show 4 years after it was discharged. Let's see. I'm trying to think about other. The minimum loan amount is $100,000.
Okay.
So if you owe $90,000 on your house, I can't do it except if you have $10,000 of debt somewhere else, we can pay that off. Yeah. Using the HELOC, so if you owe $90,000 on the house and you owe $20,000 on a car, like you were talking about with your policy, right? We can use that we can pay off the house for the $90,000, and then we can use the HELOC to also pay off the car, which would get you to $110,000, and that's perfectly fine.
What about investment properties?
I can do investment properties if we have a HELOC on the primary also.
Okay.
So. And now we're going to get more like there are multiple avenues and strategies that we can talk about. Mm-hmm. The velocity banking strategy that helps people pay off their homes really quickly. The factor, and I would love to say the most important factor. It's not the most important factor. It's the only factor. The only factor that matters here is cash flow is surplus, period. That will overcome your balance. That will overcome your rate. That's it. That's the thing. It's like we're going back to like Dave Ramsey concepts here. And I know that we're not branded to him, and you're not supposed to say other people's brands, but if you don't need him because you follow what he does, whether you learn from him or not, if you live like that, I can't guarantee it'll work, but you should really look into this, right? Because that's what matters here. And so, man, I love these tangents, but then I get there, Hannah, and then I forget where I started. Where was I going with this?
It's just investment properties.
Okay. So you're right. So you don't want to separate the cash flow into two places. You don't want to have the investment property be reliant, the investment property's cash flow to be reliant on paying down the debt of the cash of the investment property, and then have your personal to pay down the debt, because you don't want to split up the cash flow.
Okay.
You mentioned this earlier with the graph, right? The HELOC functions as the financial hub, where you put money out and you can take money back, right? You put money out and take money back. The graph that you had a segregated account that looks like it's the hub because it's the big middle one, right?
Yeah.
I conceptually, not necessarily, but I conceptually identify the HELOC as the hub. I'm biased too. I mean, one of my emails is anthony@firsthingheloc.com. That's where my focus is. But I see the HELOC as the financial hub where all the income goes, right? If you're going to invest, you pull from the HELOC and do the investment. You put the money back in the HELOC because that pays the balance down. The way that I see it, and you may disagree, is you use the HELOC to fund your policy and then pull the money back from the policy into the HELOC. That's my opinion, right? We can dig more into that later, but
we're gonna get into that in Tampa because we have. But see, that's the thing. I mean, I believe that there's no one right way to do everything. There's no one silver bullet out there for everybody that's going to solve everybody's problems.
Yep.
I mean, even with the infinite banking concept, it's just like with the HELOCs. If you're not disciplined with your money, you're spending more than what you make. No, the strategy is not going to work for you.
No financial concept's going to work if that's the case, right? And so to sort of go to talk about the investment piece, because what you want to have is you want to have a financial hub that is your debt reduction hub. That's your debt reduction HELOC. And so you use that to shift debt to this place to pay down that debt really quickly, because that can save you tons of money on overall interest costs by doing so. Well, then when you have additional HELOCs, it's when you have properties that are generally is when you have properties that are sitting in good equity positions so you can leverage the equity. Now, we're not comparing the rate of the HELOC to that mortgage. We're comparing the rate of that HELOC to hard money. Because now I've got $300,000 in an investment property that I can leverage at 8% today using a checking account. As compared to, let me call my hard money guy, and I don't know what it is. Someone said it was 8. I want to find their hard money guy at 8%, right? Like 11, right? Maybe 11, maybe 10 or 11, and you might
private money. I ain't going any less than 12.
Well, okay, 12%. All right, so right, okay, so this it can give you another avenue to access capital immediately. I mean, you can go to SoFi immediately and get $200,000 at 17% and a 5-year amortization. That is expensive money, and it kills your cash flow. You can go to Hannah and borrow at 12%. And Hannah's source is really solid, right? This gives you another option if you're sitting in a good equity position with an investment property to borrow at 8.5% immediately. And so that is one of the main values in terms of the investment property piece when you have a financial hub. So that's really why you'd want to have two, because one is going to be your debt reduction hub, that you shift debt even from the investment property here. The debt gets stored here because that's where it gets paid down so fast. Well, now you're sitting on a ton of equity that you can't use. Well, get a first lien HELOC on it. And so then what that does is open up the equity for you to leverage and grow.
Yeah. No, and it's powerful.
And y'all, if you want to dive deeper into Anthony's presentation, it's a 20-minute video. I posted it up here on the screen. go.firstlienheloc.com/offer. You can see Anthony walk through exactly. He does it a little bit better than I do because, again, he's the expert here. But
you're pretty good, Hannah. You've gotten it pretty good. I know, I appreciate that. Yeah, check it out. It's a comprehensive webinar. It'll, there are people that charge $4,000 to $10,000 to educate people about this.
Yeah,
we made I don't believe that education should, it's not that I don't believe it. We chose not to monetize the education. Let's just put it like that, right? Wow. And so, what I hope is that webinar is an extremely effective way for people to quickly learn about this. I did apply some educational concepts to building this, and tried to make it in a way that is palatable and understanding, that anyone can understand it without hopefully not, being too patronizing or basic, right? And so the goal of that was just to provide a comprehensive education from a foundational standpoint, so that way you can either filter yourself in or out, right? And understand it well enough to where you come to the table with mid to high level questions, because that'll happen. There'll be more questions that you have based on what you understand so far. So instead of a call lasting an hour and a half, the call can last 45 minutes. And you still get the same exact experience and support that you would otherwise. And so, yeah, check that out.
Anthony, I did put your link in the chat box as well. So y'all in the chat, if you want to get in contact with Anthony and his team, just have a conversation. That's what I say all the time. I had this one gentleman last week. He met me through Facebook. And so he booked on my calendar, and then he sends me a DM in the morning before we were supposed to meet that evening. He goes, Hannah, I just don't think I'm in a position to start right now. Should we just go ahead and cancel our meeting? Which I really appreciate, okay? Because everybody's time's as valuable, right? But I said, no, let's just hop on the phone. Let's just talk for 5-10 minutes at max. Let me just give you some feedback. How can I help you get into the mindset so that you can start this? And then if you got questions, we can talk about it from there. So just have the conversation, y'all. What the questions that you have, get them answered by Anthony and his team, because they're my go-to people. And this is something I'm going to be doing in 2026, just to allow me to have access to dollars. Because again, go put my little green men to work. And I always say, what good does the money do besides just sitting inside my floorboards, right? We talked about this last week. Y'all remember that quote by Robert Kiyosaki? Let me pull it up. And after I say this, Anthony, I do have one question for you in the chat from Mr. Dexter. But Robert Kiyosaki says, I use debt because debt is tax-free money. That's all we're doing.
Yep.
So, Anthony, before we close it out here, because I know we're here at the top of the hour. I know people are going to get on with their days. Dexter's asking, can equity be used as income? Have a scenario of over 1 million in equity. However, income is limited and they're behind 90 plus days. Just getting back in the groove, catching up on mortgage now.
So unfortunately not. So equity serves as an asset as compared to income. So there are ways where equity can be used to show reserves, meaning stored money, as compared to an income source. No, unfortunately not. We're working on, well, I'll leave that for another day. I always throw out these things that I'm working on, they don't happen, or they don't happen soon enough. But no, that's a good question. Oh yes, sweet. Who is that?
Declared ruler. If you want to.
Declared ruler, dude. Thank you for the shout out. I love that you have one with us. This is great. You don't understand. There's nothing better than someone validating what you do.
Yeah.
The biggest challenge that this whole concept has is skepticism.
Yep.
Because people don't think it's real. They don't think it's possible. They think it's a scam. Well, it doesn't work for a lot of people. That's true. I'm not going to pretend that it does. It's not a one size fits all thing. It's a, does this fit you? And if it fits you, you're going to crush it, right? But if it doesn't fit you, don't get it. I mean, that's okay. And we can help you figure that out, So Declared Ruler, thank you. I appreciate the shout out to me. I could be a really good liar. Maybe I'm not a good dude, but I think I am. But I appreciate the shout out too. So thank you.
No, thank you, and thank you for being on. Anthony, you will be joining us in Tampa at the end of February. So reminder, y'all, February 27, 28, and even March 1st. Go and snag your tickets, moneygamelive.com. Anthony will be out there teaching on this. And then we're going to do something together. Anthony, I haven't even talked to you about this, but we're going to do something together about marrying the two concepts. Now, real quick, before I let you go, you own policies. Are you using your HELOC to fund your policy premium?
This is not me coaching anyone to do this. Because the strategy has to fit the person. Right? That strategy fits my person. I know the risk that's associated with it. I have safeguards in place. Yes, I do.
Good. All right. And if you want to talk more offline with Anthony, okay, so I put his link in the chat. Also, Anthony, let's put your email in the chat as well. Anthony at firstlienheloc.com. So there y'all go. If you want to reach out to him directly too, you have his email there. No, seriously, this stuff is very, very powerful. And so as I just expand just in my own money knowledge and getting into different tools and vehicles, this is stuff that I'm really, really interested in, because even for my future, I want to do more than just private lending that I'm doing right now. I want the residential assisted living space really, really speaks to me. Yes, maybe because it's more personal with Papa and Nanny and what they're going through, but also just building equity in houses and building the empire that we have, starting up other businesses, buying land. So there's just so many different avenues that you can go down. But here's my biggest advice, y'all. I know every week that I come in here, we're talking about different topics. More so, it's always along the lines of the infinite banking concept, but I'm going to continue to bring on guests here that they are experts in their own fields as well. Don't feel like you have to take everything on at once, okay? Just take one nugget. Even when you all come out to Tampa at Money Game Live, there's going to be so much information flowing. Don't feel like you have to take everything and start implementing it right away. Just get that one specific nugget and that one piece of information and take action with that. That's what I did with private lending. Yeah, I would love to have my short-term rentals, long-term rentals, and different things too, but I needed to get in the know of my private lending first, and then I'll expand out where. Yeah, you guys feel me. But that's my biggest piece of feedback, okay? So continue to be a sponge. As Nelson Nash always says, don't ever hit that arrival syndrome, okay? And I see one last comment before I close it out. Dave's asking, Hannah, will you be doing a book signing for the companion at Tampa event? I will. I'll even have a merch table set up. So I got some books I'll be bringing out: Becoming Your Own Banker, Warehouse of Wealth, Case for IBC, my book, The Companion, Dad's book, Mapping Out the Millionaire Mystery. So we will have that set up. And yes, Dave, I can do that for you. Declared Ruler saying this product will get you where you want to be if you have the discipline and desire. Absolutely.
Absolutely. Yep.
Anthony, any last closing thoughts?
Just wanted to say thank you, guys. Watch the webinar. Take a look at that. Get that foundational knowledge first. Do that first. Take a look at it. The website's right there. Do that first, and then reach out with additional questions. There is a calculator online that'll give you the ability to kind of run your numbers with that too. Would definitely advise trying that as well, because that there's the conceptual side, and B, it's like with your numbers, what's going to happen. You'll have the ability with that site to do both. And then at that point, you will have a good foundational understanding. You'll have the numbers to validate whether it's a good fit for you or not. And if it is, then click the button, book a call with our team, because we're here to help and we'll validate everything, whether it's great or not. So anyway, thank you, Hannah, so much. Thanks everyone for being here and giving the opportunity to be part of the conversation.
No, absolutely. All right. Until next week, y'all. So I will be back next Thursday. Actually, I'm going to be in my van. I'm bouncing out on Saturday. Going to live in the van for about a month. Very, very excited. So
Down by the river.
Down by the river. I'm the wealthiest woman living down by the river. I'm going to tell you. But next week, I have another special guest coming on. So you want to be back. And as always, if you don't catch these lives, this is on YouTube, on the Hannah Kessler channel and the Money Multiplier channel. And it's even a podcast. So if you go to wherever you stream your podcast at, Money Mornings with Hannah, you'll be able to see those recordings as well. And also every Tuesday, go and check out the Money Multiplier podcast. A new episode gets uploaded each week. Yesterday, I sat down with my father. So if you're kind of missing Mr. BK, Brent Kessler, he's going to be showing up on an episode soon. And until then, y'all, do well, be great, and I'll catch you next week. Bye, everyone.
Bye.